Thanks for joining us today. Unfortunately, I got cold, so today I wouldn't be talking much. Anyway, Igor is our speaker for today. I know Igor for like 5 years or so, and we've done a couple of webinars, and one of his hits is cap table. This is not a very sophisticated stuff, but since a lot of founders encounter it for the first time in their life, there is a lot of there is a lot of misunderstanding around it. So we decided to cover this topic and show how to do it, give you an idea so that you can do it yourself and keep your cap table organized. This is a part of a series of webinars with regards of a course of venture analyst. We'll be launching it in a month or maybe 2 months from now. And now we'll be giving a couple of lectures like this. So Igor, welcome. The floor is yours. Sorry. Yeah, and the last organization moment, we will be Igor will be maybe given a webinar for an hour or so. You can write your questions during the webinar. Please don't interrupt, but Igor will manage maybe answering the questions along the go or at the end of the webinar. So welcome, Igor.
Yeah, thank you, Denis. So I have shared the files, so you can find them in the chat. Please write if somebody didn't find them.
Actually, I don't see them. Maybe this is some sort of a problem. But anyway, we will be sending them.
I share to everybody.
Yeah, I see that you shared, but I don't see the files. So, but anyway, we will be sending them afterwards, so don't be frustrated about it.
Okay, got it. So let me please share my screen and I will. Okay, let's go. Let me please share my screen, my slides. Okay, one moment. Slideshow. Okay. Do you see my slides, Denis?
Yeah.
Okay. So the capitalization table. I have shared with you 4 Excel files and 1 presentation. So let's go with the presentation forward and check Excel file. And file was in the Excel. So, okay, capitalization table. A few words about me. So I'm responsible for investment in Intema now. I used to work before in different companies connected to venture capital. So yeah, you can always write me an email with your perfect pitch. So let's start forward. What is a dilution? So for example, so talking about capitalization table, it's just a simple table where you can find users and corresponding shares to these users. For example, A has 30%, B has 70%. It's obvious. Let's see the example. So we have some users here, and almost all users have their own shares. But there could be some problems because, for example, some activities like dilution and other rules exist. So let's start from the simple dilution first. Okay, let's assume that the company has 2 founders, and the A and B has have 100% of the company. Okay, so C as a venture investor, early stage venture investor enters the game and is going to take 15% of the company. So I don't know, maybe it's a good seed round. For example, 500,000, 15%. Is it okay? It's okay. So what's going to happen with next? What's going to happen with our users, with our shareholders, current shareholders? So A plus B have 100%. Now they're going to have for 15% less. So it's going to be 85%. So it's obvious, yeah. Share A multiplied by 0.45, it's new share A. Share B multiplied by 0.85, it's new share B. So they had 30 and 70 multiplied by 0.85, that's going to be 25 and 60. So 15% is the share of the new founder. But there could be a bit different issue. So for example, C entered the game, but share of A is fixed for some reasons. For example, it's written in agreement that share A is fixed. Okay, so then share A new equals the share A before. And now how can we calculate share B? Let's check. So, you know, share A didn't change. It's disproportionately huge. And all investments, all shares were taken from B. So how to calculate it? We just have 85 new percent. 85% must consist from A and new B. So it's going to be 85 minus 30% is going to be 55. So you see, so it's not very proportionally. So 60% and 55%. So maybe it's going to be a good idea not to fix share A. So let me switch to Excel. Let me switch to Excel. You can find this dilution example in the file. You can find this dilution example in the file dilution 0. So I think it's quite obvious example, but okay, yeah. That's the A plus B honest dilution. You see there is a previous share multiplied by 0.85 and totally it's 100. There is not very honest situation because A is fixed and B is calculated as 85% minus 30. So B, shareholder B was disproportionately diluted. So let's move forward. Let's move forward to the presentation. Okay. One more example of cap table. So you see a bit more difficult, a bit more complicated situation. Here we have some members, 1, 2, 3, 4, 5, 6, 7 shareholder, even share option plan. We'll say a few words about it. You see, so these guys 1 and 2, They have ordinary shares held. So I think they are founders. They started from the beginning. Totally, they have 45%. Now we also we have a shareholder. I think it's an early stage investor because he has a preference class of the shares. And also we have users 4, 5, 6. I think it's Angel Syndicate. I think it's Angel Syndicate. These guys have totally 11%. Also, we have 7 user. I think it's the next round investor. It has 20%. And we also have a share option plan. Okay, so we have ordinary shares 29,000 and about 30,000 class A preference shares. What's the idea? The idea how to calculate shares to be issued on the next round if new investor comes. New investor comes with ready valuation. For example, investor comes and says, okay, I have a valuation 28 million US dollars for these startups, and I'm going to invest 1 million of US dollars. So I want to receive 3.5%. Okay, does it work? Yeah, it works. Let's go to the calculation. Let me share my screen again and open the file cap table dilution example 1. Okay, that's it. Moment. Okay, that's it. If you see it, it's perfect. Okay, for example, you have these members. You also can open this file if you can see the link I shared. If not, it's okay, Denise will send you. Okay, this is number of ordinary shares held. It's hard numbers, percentage. It's calculated by the division number of shares by the total number. Okay, so we need to receive, new investor number 9 needs to receive 3.5%. Okay, so the main idea of this calculation is that the old amount of shares, 59,760, now it's not 100%. It's not 100% anymore. It's 100% minus 3.5%. It's 96 and 5. And we use this calculation to run our table. So what can we do? We divide 59,000, so the previous numbers of shares, divide by 96 and 5%. So now 100% of shares is 61,000. But we didn't receive the exact number of shares. We have any tens, hundreds, thousands after the dot. So I think we should round them. We should round them. We say that 69,927 is 100% of our all stocks. Then we calculate these shares minus all numbers of shares. We calculate the new stock, the stock of the new investors, of the new investor, and then we step by step calculate the share, the new share of each investor. So we would like to receive 3.5%, but you know the number of shares is sometimes can be rounded. So because we have exact number of shares, and number of shares is not always millions or billions, it can be just thousands. That's why we can't receive the exact very precise number 3.5. That's why we receive a little bit more stake or interest, or a little bit less stake or interest. Here we received 3.49. So that's a new cap table. You can see everything is the same, but shares of the all investors proportionally decreased by 3.5%, or I would say were multiplied by 0.965. So let's calculate. Let's see the relation. So I think it's quite obvious example. Yes, that's it. 96.5. Okay, let's not save. Not save. Let's move forward. Any questions you can write here. While I am closing all the files. No, don't save, don't save. Let's move forward. Okay, we went through the dilution example. So a bit more complicated cases can happen. For example, we have a simple cap table. We see one, we see two. They want to receive preferred shares for 4 million, I would say, dollars. We have founder one, founder two. They owe 4 million shares. Let's call it $4 million. And we have employees and options available for 2 million. So it's also simple. So it's typical. It's how typical simple cap table looks like. But there could be different stages. So for example, this is a real cap table. So we have I excluded the names because it was a real cap table. So ordinary shares, preferred shares, ordinary warrants, warrants A, warrants B, warrants first round, second round. And you see that, for example, these guys invest not only in one round, they also owe different instruments on different rounds. For example, this line, this investor has ordinary shares, preferred A shares, preferred A1 shares, preferred A2 shares, and ordinary warrants. So he used to invest in different rounds. So yeah, that's how it works. Yeah, and it's not really easy to calculate his or her final share, and it's not easy to understand his or her final share shares ready for vote. Because let me show you this pyramid. So we have investors. They have preferred stocks with most rights. As you saw, yeah, there is a preferred. Then we have founders with common stocks, ordinary shares with special rights, and employees. They have stock options. Typically, it's the most simple ordinary shares. Preferred common options. Investors, founders, employees. Preferred ordinary stock options with the most simple ordinary shares. Okay. How to calculate all the shares? How to calculate the share investor is going to receive? To calculate the share investor is going to receive, we must understand the total number of issued shares and shares to be issued in this moment. For example, we have 1 million common stocks and would like to receive 5%. How much shares can we receive? 500,000? I think no, because there could be also stocks, other options, warrants, and so on and so forth. So we must calculate this 5% we would like to receive based on the idea how many shares are issued or to be issued. So we call this number of total shares as a fully diluted basis. Typically in term sheet or in shareholder agreements or in other agreements for share issuance, you can see this text, this or something like this. Fully diluted shares are the total number of common shares of a company that will be outstanding and available to trade on the market after all possible sources of conversion, such as convertible bonds, employee stock options, and so on and so forth. Why does it matter? It matters because it affects the price per share. So the many shares you have, the less price per share will be. Okay. So it's also a quotation from shareholder agreement, and also one more quotation. So here's written that subscription shares, I think it's shares issued, for example, 3.5% from our previous example. And how is it calculated? On a fully diluted and after issued basis. Also, issue price means some price, being the price per share on a fully diluted basis, assuming full issues of all shares pursuant to share option plan. So if you promised somebody to issue some shares, you must take them into account when you're trying to issue more shares. So it's quite obvious idea, but okay. Fully diluted share capital. I think there is a very important point in this calculation called ESOP. Let's look through what it means. ESOP, it's employee stock option pool. So it's option to be issued for employees, for the guys who are working for the startup, because you must motivate somehow very expensive people. You can't pay them enough money when you're in startup. So you must, maybe not must, but you should issue for them some options. Typically, it's 10 or 20% from the total interest from the total share in tech companies. So they used to receive, for example, so if it is CEO, if CEO is not a founder, it happens sometimes, he or she can receive 10%, vice president 3%, senior, junior, CTO, director, member of board. Of course, we are not talking about founders, we are talking about employees. So they can receive these shares. Why am I talking about it? Because it's very important part of capitalization table. So in capitalization table, not only investors and not only founders, but also employees. Okay, how can these guys receive the shares? It's not an easy question because, for example, we have a CEO and say, dear CEO, you will receive 10% of the company. He says, okay, how are you going to vest me this money? How are you going to give me this 10%? We say him, okay, you are going to work for 1 year and you are not going to receive nothing until the end of the first year. So 1/4 of your share you will receive at the end of the first year. It's called cliff. This period is called cliff. Then you will receive proportionally, month by month, vest over the remaining 3 years. Let's see how it works. So for example, we have 100%. 100% of the shares offered to the CEO means, for example, 10% or 5% of the company. It doesn't matter here. We say that it is 10%, 100%. Okay, then quarter of all shares is issued in 1 year. So 1 year is like a probation period. It's like you pay him only salary. And then step by step, every month or every year, you can vest him proportional share of the stocks he must receive. So here is the steps you can see. And here is a 3 years vesting. So your CEO receives nothing, but then 3 years comes, he takes 100% of his shares and goes away. Okay. So let's through the example. Let me see the questions if they exist somewhere. Have you received the files I shared in the beginning of our meeting? Could you write me something? Okay. While are you writing, we are going through a table example. For example, you have a startup and investor comes and says, okay, I'm going to invest, let's say, some million in your company. So we evaluate your company for $10 million US. Okay, so we are going to invest 4 million in your company. It means that pre-money valuation is 6. 10 minus 4 equals 6. So you have some issued shares. It doesn't matter how many shares you issued before, but it must be million of shares just for convenience, for your convenience. Okay. And there is a question, how many shares is investor to receive? I would say it's a simple proportion. Shares to invest equal 4 multiplied by 4.6 divided by 6. Here we go. 4 multiplied by 4.6 divided by 6. If we revert, if we divide 6 million by 4.6 millions of shares, we receive the price per share. This proportion is called price per share. So, okay, now we can receive the same with dividing 4 million invested, dividing by 1.3 is the price per share. So our investor is going to receive 3,067,000 blah, blah, blah shares. So simple, obvious. Let's go through the example. Here is a simple situation. 4 million to be invested, 6 million is evaluation of pre-money valuation of the company we had before. Simple, 6 plus 4, 10. But not everything is clear, because we could have issued options, stock pre-money options. They had to be executed. Debts can be converted. They can have discount, and they can have interest. So it's called convertible debt with interest. And that's why we will have the effective pre-money valuation. It's not going to be 6 billion US. It will be changed. It will be affected by our options and our debts and our shares to be converted. So the more shares you issue, the more convertible notes, convertible debts, options for advisors, options for your users, for your for people working for you, you issue, the less effective valuation you as the founders will receive. So it's quite honest situation. Oh, also post-money options can exist. Let's look. Plus. Oh, people received. Okay. Let me open the file. This is gonna be the file venture hacks cap table. The file is opening, and I'm going to share it. Venture hacks cap table. I downloaded it from site. You can find it into the disclaimer, the last page. Let me share the screen and go step by step through this valuation. Okay, that's it. If you see my screen, yes, you see. So let's clean everything. Let's clean everything. Let's clean everything we had. So what's happening here? We had 4 million shares issued. Investor comes and says, your company is worth 10 million US dollars and I'm going to invest 4. So 10 minus 4 equals 6. So we have 4 million shares and the price is 6 million. So price of one share is 1.5. It's easy to see. Share price is 1.5. There is a bit more complicated calculation inside. We will focus on it further. So these guys invest 22 million, investor 1, investor 2, totally 4. How many stocks can we receive? We will divide 2 by 1.5. So 1,000,333 shares is going to be 20%. So everything is obvious. But what happens, as I used to show before, what happens if we issued some stock options for our, let's issue stock options, this, and this. For example, we have employees. For this employees, 200 shares. For this, 100, 100, and totally we gave total options about 6%. Does it fair? Yes, it's fair. Is it fair? Yes, it's fair. But these options will change our price of our share. How does it happen? Because before we had 4 million here, now we have 4,600,000. So let me kill this. It affects the price. So we had a price 1.5. Now we have a price 1.3. It means that different number of shares will be issued. And how will it affect the total ownership of the company? It will affect the total ownership of the company because new investors are owners of the 40%. That's okay, this is what we had before. But our founders now don't have 60%. Our founders plus employees have 60%. That's what this 100,000 shares did. They changed the price and they changed the way of calculation. So let's move further. And let's use different idea. Also, we had two lenders. they lended us in the very early stage 50,000, totally 50,000. Two lenders, 25 from each other. And this 50,000 must be converted to the shares. What's the problem can we see here? Oh, the problem is very easy. Because first of all, there could be a debt discount. Let's come back. Debt discount. So it means that this 25,000 will wait for 35% more. They are calculated with the usage of we divide by 1 minus 35%. It's a quite tricky point, but if somebody gives you debt, always look at that discount, because if that discount will be 100%, you will lose your shares not for 25,000, you will lose your shares for 50,000. It's an obvious thing, but it must be taken into account. And also there is a percentage, because it's debt. So if it's debt, you must receive not 40,000, yeah? You must receive, for example, 40,000 with some kind of percentage. Here percentage is not taken into account, but if we had, for example, 5%, 5 annual percent, or maybe 10 annual percent, and let's, I don't know, 1.5 years, it's 18 months from 12. We are going to receive not shares for 25,000, we are going to receive shares for 28,000. And if we divide this by, so you use the same calculation here. Now let's copy. We will receive 46,000 shares. 46,000 shares, it's more than, what's the total number of shares? 10 million. 0.4% instead of 38%. It's quite sufficient sum of money. Also, this discount means much. Typical amount of discount is 20%, but it can be also 40, for example. 35 is quite much. And also what we have here is the post money option. We can delete it. That's okay. 20% for new investors, 0.77, about 1% for lenders, and 59% left for founders and equity share option holders. But if we insert here 50% post money option, we reserved for some matters what we receive. Lender share didn't change. Let us check it. Yeah, didn't change. Investor share didn't change. Post money option appeared from 0 to 15%, and common stock and pre-money option appeared again. What can we see here? Let me show you again. What can we see here? We saw this principle. So before, we could have a 6 million pre-money valuation share as a founders, but after it, debts, options, post-money options, pre-money options killed our value, and we receive, let's call it effective pre-money value. It must be 6 million, but how much is it? How much is it? Let's check. Effective pre-money valuation is 4,400,000. So yeah, sufficiently lower than we could receive. So the idea here, not give strange options to strange people, 0, not give a big debt discount, and don't give too many options to your employees. It looks better. 5.95 looks better than 4.4. That's it. And here we can see, let us go back. Let us go back to current situation. The digits are blue here, you can change. Everything other is a calculation. Also, you can see here the initial distribution between founders and options, then post-money valuation after investors came and received some money, and the lenders also received some shares. And you can see value of the shares, and you can see exit value. For example, we set up exit value of the company is $50 million. So it was 10 before, and after 5 years, we can sell it for 50 million. So we have a multiplication 5x. What happened with our investments? So here we received 5x multiplication, 5x multiplication. Yeah. So that's it. Value of the company increased. So let's go back to the slides. Let's go back to the slides. Let's go. This example we looked through. 6 million shares to invest. One more interesting point. You saw here that lenders, so no lenders, no investors on early stage, and investors on early stage. Number of shares changed, but the ownership of investor didn't change, because all stocks, all options, all lenders took the shares, took the money, took the interest from the founders. But there could be a bit different situation. So if we calculate a fully diluted share capital prior to issuing the offered shares, if there were many, I don't know, instruments like convertible debt, like equity ESOP, like SAFE, you issued, you take money through SAFE. It means that the ownership of the investors and the ownership of shareholders will change, will be diluted proportionally. Let's look through the example. For example, Tim had such number of shares, 15,100. New equity investor comes and wants to receive 10%. Okay. Is it okay? Is it okay? But if there were many convertibles, so the investors to be converted on this round, they will receive also sufficient share, about 13%. And this number will proportionally decrease the shares of the team, you know, and will proportionally decrease the share of new equity investor. He must have received 10%, but he is going to receive 866. How does it look like? Let's go to the example. It's our last file. It's called cap table 4. Let's go to cap table 4. Let me share my screen. You know, it's always better for shareholder to calculate the shares based on pre-money valuation prior to the dilution, but not everybody agrees with it. So, okay, you have a founder 1, founder 2, founder 3, total number of shares. Okay, the new investor comes. I would say I have one more investor, 100,000 he invests. And I have investor 1, 2, 3, 4, 5, 6, 7, and they invested with different caps on different rounds. 10,000, 25. I think it were angels. With cap 2, with cap 1.6, with cap 1.3. And these convertibles must be converted on the first equity round. It's not a very interesting situation for new equity investor because his share will be changed, will be affected by these shares to be converted. But what can we do? He can insist on his share 10% or calculate a fair value based on the pre-money valuation share price. Let's calculate this price, share of the price. Okay, we will invest 1 million. So our valuation is 9 pre-money. So total is 10. We are going to receive 1/10. So the number of shares we have to calculate is this. So data, what if, parameters. So we must set up in this cell 10%, changing this. Okay, let's go. Okay, it means this numbers of shares has to be issued on this round for this company to receive 10%. Okay, okay, but let's move further. Because shares to be converted are awaiting for us here. We have at least 60, we have about 215 to be converted. It's okay, it's okay. Let's calculate share price for each conversion. What's the share price? We divide cap by the numbers of shares. We divide cap by the number of shares. We divide cap by the number of shares, and we divide cap change cap by the number of shares. So it means that the price of share for each participant is different. For the guys who had the valuation cap 1.3 million, the price of share is 77 euros. For these guys, it's 95. The higher the cap, the higher the share of the price is. Okay. But here you see there is a 1. I inserted this 1 because when the investor comes, and if he or she knows that there are too many guys, too many investors of the previous rounds and angel to be converted, he says, okay, I know that I'm not going to receive a fair share price. Please change the share price for me, and let's multiply it, for example, by 0.65. It always happens. It always happens. If you would set up 1.1, it will be 60. Of course, it can be 60, but 300 is quite enough. If the cap was very high, I would say 9 million. 9 million. So the share price for this guy would be very high. Let's calculate this. Okay. So this condition with this coefficient only works when you have a very high valuation cap. Okay, anyway. Can you issue here some shares? Yes, we can. How much shares can we issue? 10,000 multiplied by 77, 129 shares for each holder. Then 105 shares for each debt holder because the cap was higher than this, and for us, for 100,000, only 296 shares because price per share and 338. And the other shares is for our new equity investor. So before we had, what did we have before? Before we had these shares and these shares. Now we have new shares, 2,000 of new shares. We have old shares, and we have new issued shares, and we have the shares of our new equity investor. So here he holds 10%, and after all the dilution, he holds 8.66. So let's look here. So as it happened, the team and the new equity investor were proportionally diluted by new, maybe not new, but by investor we already had in cap table with the convertible notes. Is it fair? I don't know. But it always happens when you have many investors with SAFE and convertibles. That's why nobody loves SAFE. Not only for this, but that's one of the main ideas. Let's close it and let's come back to the presentation. Okay. That's we had. I create a small demo. Look here, fully diluted share capital immediately prior to issuing the offered shares. So we calculated not prior, we calculated after, and now we calculate prior. We don't receive 10% and 90%, and we don't receive the debt and all option taken from the share of the founder. We receive debt and all option, changing the value of the investor and changing the value or share of the founder. That's how it works. That's it. I would say that it is the main idea for calculation the valuation. Typically, diluted share capital prior to issuing the offered shares. So we calculate the pre-money valuation share price typically. Few words about services for capitalization. Excel is the best instrument to calculate everything. But if you don't want to do it manually, you can use captable.io, carta.com. You must pay them sufficient money, 10 or 20 euro each month. So I don't know how they work. That's why I recalculate every cap table I receive from the service, because it's not easy to understand. Was it evaluation? Was it a pre-money, post-money? How did they calculate the percentage? Was it a multiplying percentage? Was it a simple percentage? I don't know. Excel is better, but always you can use the services. And also there are additional materials. You also can take them from your from the presentation. Also very interesting example. So for example, you had a founders. It's example of growth, of the growth. So company grows and the second investors grows. Why only 2x and company grew for 12.5x? How did it happen? For example, you had a founders, investor came, he invested 2 million for 10%, okay, valuation 20. The new investor came, invested 50% for 15 million. Okay, new valuation is 100. Shares were diluted by 0.85 from 10 to 9, but the value of each interest increased. Value of founders were 18, now it's 76.5. Value of investor 1 was 2, now it's 8.5. And the same happened with investor 3. He also came, but what happened between round 2 and round 3? The valuation increased only 2 times for the investor 2, and for founders valuation increased 8.5x, and if we take into account the whole company size, so it was 20, now it was versus 250, so 12.5x. That's why it's very important for investor 2 to receive his multiplier, to receive his 3x, for example, or 2x. That's why it's very important for him. For example, an investor comes to you and you're a founder and he asks you, please, let's make a valuation 12, not 15. For him, it's gonna be 2.8 valuation. Almost 3, yeah? You just change the evaluation a bit. It didn't change your value, it didn't change your money, it didn't change your revenue. But for investor, it could be very crucial. For investor, a small change in the valuation can be a deal breaker. If he comes, he or she, or if he or she doesn't come. That's the main idea of the slides. Please look attentively. Don't be very greedy to the valuation. Yeah, let's look through the questions. Denise, I think we are almost done.
Okay. So if you have any questions, feel free to ask them in the chat. While we're waiting for questions, thank you, Igor, for your elaborate presentation today. I hope it will help people to do their valuation properly and their cap tables in place. And just, I don't remember if you mentioned it or not. It's really important to keep track on your valuation at each stage of investment, especially when you're dealing with safes and convertible notes, because you may feel like you have the ownership, a big chunk of the company, while if you convert everything properly, you can be holding a much more smaller share.
Mm-hmm. Yes, but it's very tricky valuation. So as one portfolio director told me, a very big fund, I wouldn't share who it was, but he told me, sometimes I sit in the morning to calculate the cap table and evening comes and I'm still calculating. so it's not an easy task. It's because I thought a year ago that I know everything about cap table, but now I see that the new horizons are coming.
To be honest, I'm not really proficient in this matter, so that's why I ask you to do this presentation.
Thank you. I opened for me this for myself this pre-money valuation because I didn't use it. I always insisted that I invest 3 million for 10%. It means I invest 3 million for 10%. Not, and it's not diluted. But no, it has to be diluted because it's a standard. Why? I don't know. But why should I pay for the founders who used to issue safe to these guys, to that guys, to these guys, to that guys, and now these shares will decrease my interest. But it's life. That's how it works.
Yeah, life is tough, especially right now.
Stuff, yeah.
Yeah. So thank you, Igor, for your presentation. I guess we don't have any questions, so let's wrap it up for today. Thanks everyone for joining in. Thanks for joining us today. If you have any questions, feel free to reach out to Igor directly. I'll be sending over all the slides and the video recording in a couple of days, as soon as I feel myself better. And more webinars are coming along the way. We'll be talking about competition, about financial modeling, and other stuff. So subscribe to the channel, and we'll be keeping you posted. Thank you, Igor. Have a great day. Bye-bye.
See you.